Good afternoon, fam. This is Trey getting in touch with you from a very, very humid Japan. My hair freaking look like Pippi Longstocking up in here. Hope you're doing well. I got a barbecue with my buddies in the evening. But first, I'm going to bring you an analysis of Discover. Before we go into the analysis of Discover, I found out while researching it, because I didn't know anything about it, I was just doing this in response to a request. Discover actually is made up of like credit and debit cards, but it's also kind of a bank, and they do loans and stuff like that. So when we're analyzing it, it's good to know a little bit about how banks make money and how credit cards make money. First of all, banks make money by making loans and providing money to people to go and do stuff. For example, I want to build a house. I go to the bank and I'm like, hey, I want to build a house, give me $100,000. And they're like, okay, but where do you think they get their money from? They have like a bunch of people, thousands or millions of people who have savings accounts or debit cards in Discover's case, where they're putting money in to get a little bit of interest. Right now the interest rates are ultra low because governments want to encourage people not to try and save money to make money on that ultra low interest rate. So in Discover's case, they have a bunch of people who put their money in their banks, and then they can turn around and lend this money out as loans. Primarily school loans, home loans, personal loans, things like that. So one of the cool things that Discover did was they said, hey, we'll give you cash back points if you put money in your debit card. So they're encouraging you to put a bunch of money in on your Discover debit card, and then when you go around and spend it, it's convenient and stuff and you're getting points, but they also use that money to turn around and give out loans to make even more money. Then on the other hand, we have the credit card side of the business. If you've seen the last couple of videos, if you haven't, click up here. MasterCard and Visa, these are really big international, super well-known, the number 1 and 2 credit card companies. They primarily operate the credit card systems and then try to get them in vendors or merchants all around the world so that when you, who have a Visa or MasterCard, go there, you can use it. You don't have to carry your own cash. And for both of those companies, a really big source of revenue is international transactions. Discover, on the other hand, is number 3 in North America, but basically unknown outside of America. And Discover focuses primarily on middle income America, which makes things kind of tricky for them. It puts them in a weird spot because on one hand, middle income people or lower income people tend to carry a balance on their credit cards. And that's another way credit card companies make money. So if I couldn't pay off $1,000 on my credit card bill each month, I'm needing to pay interest based on whatever that credit card's standards are. I'm needing to pay interest on that $1,000 I'm borrowing from them every month. And that's just cash in their pockets. And that's neat for Discover because they're targeting people who are most likely to carry a balance. On the other hand, the downside, especially compared to Visa and MasterCard, is that they're not going out there and targeting high-income people by saying, hey, if you use our service and you get enough miles, you can fly to Tahiti or Hawaii or wherever and stay in this gorgeous hotel. High-income earners are trying to do those things. They want to achieve those things. But also on the flip side, high-income earners are more likely to, say, pay off their bill every single month, in which the credit card makes no money. So looking at Discover, it's interesting because on one hand, a lot of their users carry a balance, giving them income. Turns out about 80% of their net revenues are from those recurring interest fees. But on the other hand, because they're not targeting these high dollar people by giving out like gorgeous rewards and stuff like that, they're also making far less transaction income, which is when you use your credit card, the store doesn't get 100% of the money you paid with your credit card. They need to pay a fee to the credit card payment processor. And another neat little advantage Discover has is that they run the Pulse network, which is one of the biggest debit and ATM networks in North America. In comparison to Visa and MasterCard, Discover Card is relatively small. The market cap is only 18 billion, whereas the other two are in the hundreds of billions, I think 400 billion. Let's take a look at some of the stats on their report card right now. The current price is $54.96, but dude, look at this 52-week range, going from $23.25 all the way up to almost $93. That's a tremendous range. We're sitting right about in the middle. They just got hammered after the market downturn. We'll see that on the charts in a minute. They have a price earnings of only 8.8, which is relatively low compared to everything else in the planet right now, because the stock prices just keep going up for no good reason. EPS, if we're looking at the GAAP EPS, they lost a quarter, 25 cents per share last quarter. They have a quarterly dividend of 44 cents, which is right on par with Visa and MasterCard, interestingly. An annual dividend return of $1.76, and an annual dividend yield of 2.99%, which is quite appealing if you're into that. Let's take a look at the price charts. Going back to the 3-month chart, you can see the destruction that happened in mid-March, along with most other stocks. You can see a nice bounce back, but actually when you zoom out, it's not quite back up. It's actually very far from all-time highs. Here's the 6-month chart. You can see that kind of gradual trend down through March, and kind of making its way back up, but still has a ways to go, which you can see in the 1-year chart. It's like, whoa, it was hanging in there at kind of like 80, 90 bucks for quite a while before it got pummeled in down to these levels. Here's the 5-year chart giving you a better idea of that. We're kind of like, if we just draw a straight line, yeah, we've hit this price in 2018, 2017, but it wasn't really steady at this price until you go all the way back to 2016. And we'll go into some reasons for that in a minute. Let's take a look at the Refinitiv chart that compares Discover to the S&P 500 averages recently. PE, check it out, much lower, as I mentioned. It's kind of on sale right now. Let's go down to the sales growth and the long-term growth rate figures. 1-year sales growth, 6.9%, pretty good. Almost double the S&P 500 average. 3-year sales growth is a hair under the S&P 500 average. But let's take a look at the long-term growth rate in the last 3 to 5 years, and you see kind of a different story. It's significantly lower. But on the flip side, going down to net margin, nice juicy margins there, 18.7% compared to 8.4% for the S&P 500 average. Their return on equity is really where Discover shines. 21.4% versus 12.7% for the S&P 500 average. Return on equity is basically a measure of how effectively management is using a company's assets to create profits. And again, this is Discover's strong point, I think. So thinking about the stock going forward, there are a few different things to think about. As you know, the sickness recently has impacted spending, and one of the difficulties with Discover focusing on middle-income families is that they're much more likely to default or not be able to pay on their credit card. This could add up to, delayed payments, meaning more interest income, but more likely it's also going to come back and hit them with defaults. One of the interesting things credit card companies do is they'll kind of, in the same way you and I should be doing, they kind of set aside like an emergency fund, a savings account, just for like a rainy day. And they set aside a certain percentage each quarter, assuming this many people are going to default. And so if we just use this savings to cover that, we'll be okay. But right after, the sickness started, those numbers like doubled up to 7%, which they weren't banking on. Hence the minus earnings per share last month. I personally wouldn't be surprised if that continues, although they've adjusted their savings rate, their emergency fund, to account for that going forward here. But they're usually pulling off a return on equity of like greater than 20%, and they're usually repurchasing shares about 5% per year. But it's unlikely they'll be able to continue that since they're having to spend so much money into this emergency fund. I mentioned in an earlier video about share repurchasing. I got a couple more questions about that. One of the cool things about it is that there's kind of like a fake demand for the stock. So if you know a company is in the mode of doing share repurchases, there's always going to be buyers who are kind of pushing up that price. And therefore, if you're holding the stock and you're like, should I sell it? Oh wait, I know there's going to be at least the company buying it back, so I can hold on for a little bit. So as a shareholder, it's kind of nice, but at the same time, it's tricky because in a lot of cases in the past, the government's like, hey, I know you guys need help because of like some economic downturn. Here's a bunch of money. And then the company, rather than using that to pay employees or invest in new technologies and hopefully spur the economy on, they'll use that cash, go around and just buy a bunch more stocks, basically padding their own wallets. And so this has become pretty controversial recently, especially for companies who are receiving bailouts from the government. But as a stockholder, it's not necessarily a bad thing. It can be a good thing. Looking back at the 2008 crisis, Discover's return on equity fell down to about 10%, but it quickly bounced back up, which is a really pleasing sign. But I think with the sickness going on right now, we're probably going to be in for a little bit more hurt in the long term over the next few quarters at least. So how should we be thinking about Discover? I think looking at all the different reports and looking at these numbers and looking at kind of their market position, they're number 3 in the market as far as credit card usage goes in North America. But it's hard to see them being a very high growth company in the future. Management has been disciplined about continuing to invest in new products and continuing to invest in new technologies, but it may not be enough to keep up with some of the competitors, especially with all the different change going on with new different kinds of types and technologies of payment methods coming around, like Square or like Google Payments or things like that. But I think it's safe to expect Discover will continue to be a high profit company. So would I buy this stock? It's actually a really interesting question right now because it dropped, as we saw in the chart here. It hasn't come back all the way up yet. A lot of other stocks have kind of come back up to where they were 3-4 months ago. Discover is still down in the doldrums, dude. So that could be an opportunity if you're willing to take on some risk, if you're willing to kind of deal with a few rough quarters. I personally don't see Discover, going out and changing the world. So I'm not going to make it 30% of my portfolio or something like that. But I may get in with a small position just to kind of, stay in for a half year or a year and pull off kind of like a cheeky 30% gain or something like that. I think it depends on your preferences, your style. They do also have a pretty nice dividend return compared to other credit card companies, but they also don't offer the stability, so you're gonna have to deal with a bunch of rough roads going forward, but it may turn out to be, a good payoff in the coming months. So if you're not risk averse, if you like dividends and you don't mind kind of watching the stocks, closely here and there and learning, it might be a good choice for you. Check it out. So those are my thoughts on Discover DFS. Let me know if you have any questions. Let me know if you have any concerns or if there are things I didn't think about or things I didn't consider in this. If you've watched this far, I thank you very much for that, and I hope this video provided some value for you. I would appreciate it if you could subscribe and hit the like button. That helps us out here very much to keep producing these types of videos for you. Let me know. Looking forward to hearing your comments and getting in touch with you. Thank you very much. Have a great day. I'm gonna have a great barbecue.